Hello and welcome to the FCC 2024 Economic Outlook. Welcome to those who are watching this event live on January 23rd, and if you're watching a recording of the event, thank you for joining us. I am coming to you today from Montreal, Quebec, and I do want to acknowledge that Montreal is the traditional and unceded territory of the Mohawk and Algonquin peoples, and it is a place that has long served as a site of meeting and exchange amongst nations. Wherever we find ourselves today in Canada, we are on traditional Indigenous territories with rich traditions, stories, and histories that should be understood and honored. And it is our commitment in the spirit of reconciliation and collaboration to honor these people as vital contributors to our society and respect the diversity and strength of all the Indigenous people across this country. In the next hour or so, the FCC Economics team will review 2023 and, more importantly, provide an analysis of the economic drivers that will be of major importance for 2024. So, 2023 was an eventful year. Inflation and interest rates were arguably the #1 topic, but that's far from the entire story. Weather disruptions, geopolitical events, shifting food consumption patterns, and numerous other factors all had some degree of influence on profitability at all levels of the food supply chain. FCC Economics estimate that in 2023, farm cash receipts went up by 3.6%. Interestingly, at the same time last year, the team had projected that farm cash receipts would be up by 4.6%, so they were pretty much right on target. Now for 2024, the projection is that there will be a decline in farm cash receipts of 4.8%, which is somewhat of a sobering projection. As per the food and beverage manufacturing sector, sales are estimated to have increased by 6.3% in 2023, and for 2024, the projection is that they will go up another 2.5%. So to get a 1,000-feet view of what these projections are telling us, let me introduce FCC's Chief Economist, JP Gervais. Hello, JP.
Hi, Darlene.
So JP, is it fair to say that these projections seem to indicate a very cautious environment for 2024?
Yes, and well, first of all, thanks for acknowledging that we got one projection right last year, so hopefully we can build on that success. Absolutely, very fair to use the word cautious. You were mentioning our projection for 2024 gross income of farm cash receipts, and we're projecting a decline in 2024 relative to last year. And this is significant in the sense that the last time we recorded a decline, so if it turns out that we do have a decline at the end of this year, the last time, or the previous time, was 2009. So it would be significant. And at the same time, we have to be thinking about input costs, right? That's the #1 topic. It's been the #1 topic for our customers, for industry stakeholders since really in the fall of 2020. And I think that's going to be critical this year to think of profitability as we think of 2024. Now, there are lots of different nuances across the ag economy, livestock versus crops and so forth. So we're going to use the next 15 minutes to unpack all of the differences across sectors. You mentioned as well, Darlene, food processing. Now, yes, we're projecting an increase in sales, but that's measured in dollars. And so if we strip out inflation, then we look at volume being sold. And in 2023, we know we had a few challenges, a few headwinds there when it comes to volume sold by food processors, because consumers change their food purchasing behaviors. And so it's going to be critical as well to think of how this is likely to evolve in 2024. So cautious, optimistic at the same time, because we do think that there are some sectors that are going to be benefiting from some profitability trends that will be favorable. But overall, I think it's fair to say cautious environment for 2024.
Okay, great. So looking forward to digging in a little bit more a little later with you, JP. But before doing so, and before getting into those specifics about agriculture and the food processing sector, I'd like us to talk about the big picture for the Canadian economy. And to do so, we'll be turning to Christian Ragasamy, FCC's principal economist. So hello, Christian.
Hi, Darlene.
So, Christian, most of the commentary that I've been reading about the Canadian economy is suggesting that the economic growth will be a little bit slower in 2024. Is that what you read also of this state of the economy at this point?
Yeah, absolutely, Darlene. The consensus in the profession is one of pessimism, and I'm going to explain why in a minute. Just to get some idea of what happened. So we don't have data yet for 2023, but it looks like Canadian GDP growth was about 1% last year. So that's about half of potential, which means very weak performance. And here, nobody should be surprised, really, that the performance was that bad, because we know that the Bank of Canada has been tightening monetary policy. Interest rates have risen from almost zero back in March 2022 to 5% last July, right? And that has had the intended impact. In other words, we've seen consumption growth slow, and we've seen investment growth also slow, and that's why we had growth, as you can see from the chart, decelerate from 2022, right? So the question is what happens next, right? So as you can tell from the chart, we're not expecting a great year either for this year, 2024, and part of that is based on expectations, right? So just last week, for example, the Bank of Canada came out with surveys from businesses and also surveys from consumers, right? So the survey from businesses basically showed us that businesses were not particularly optimistic about the economy, and what that means is that they're not really optimistic about spending also. And more concerning, perhaps, was the survey on consumers, where the majority of respondents to that survey basically just told the Bank of Canada, you know what, we're thinking about reducing spending, right? And if you're thinking that, this is not really surprising as well, because more than 15%, as you can see in the next chart, more than 15% of disposable incomes are now go towards debt servicing, right? So that leaves less money for consumers to spend on other items. So that's problem number one. Problem number two is the labor market, right? So I talked about that business survey from the Bank of Canada last week. That survey not only showed that business sentiment, businesses not really confident about the economy, but it also showed that businesses, were not really keen in hiring, right? So that index was the worst since 2016, right? Which just gives you an idea of what's going to happen to the labor market in 2024, right? So we're expecting the jobless rate to rise, so that's not great news for the consumer sector. And again, the consumer sector accounts for 60% of Canadian GDP, right? So if that slows down, the economy as a whole is going to slow down. So which explains why we're forecasting growth of less than 1% for this year.
Okay, so I sense that we've not yet fully experienced the impact of the rising interest rates that we've seen in the past year or so. Yet I understand that inflation is now declining. And so it makes me hopeful that interest rates will also be declining in 2024. Is that the case? What is your projections for interest rates?
Yeah, absolutely right. Look, so inflation is, you're right, it's dropping. And as you can tell from the following chart, so it's been trending down, right? So, and like I said at the beginning, we're forecasting growth to be below potential, right? In other words, you can expect inflation to keep trending towards the Bank of Canada's 2% target. And so the question is, what does that mean for interest rates, right? So markets have already started to adjust to downtrending inflation. If you look at long bond yields, for example, as you can tell from the chart on the screen here, long bond yields have already dropped about 100 basis points since October, right? So markets are basically just telling you that, you know what, we understand that inflation is coming down, and they're trading accordingly. And you can see from the chart that the short yields haven't moved, right? So the short yields are tied to the Bank of Canada's overnight rate. And the question is, when is that going to move, right? So our own forecast is for the Bank of Canada to start cutting interest rates in the second half of the year. We have 75 basis points of cuts in the second half of the year. But the Bank of Canada is going to do that only if they become comfortable about inflation, sustainably going down, right? So that's why we think they're going to wait a little bit, and that's going to happen in the second half of the year.
Okay, and finally, Christian, I'd like us to talk about the Canadian dollar. I understand that the state of the economy and interest rates both have a strong impact on the value of the Canadian dollar. And we know that the loonie is a really big driver of profitability for many farm and food processing sectors in our industry. So what's your projection for the value of the Canadian dollar moving forward?
Yeah, well, based on what I just described, which is, interest rates going down, weak economy, you would think that, the Canadian dollar is doomed, right? But it's a bit more complicated than that, right? So let's go back about 20 months, right? So as you can tell from this chart on the screen here, we were at 80 cents US, right, in March 2022. And now we find ourselves at around 74 cents, right? So what happened in that period was basically the Federal Reserve in the US, they started raising interest rates, right? So the Federal Reserve have actually raised interest rates faster than the Bank of Canada. So we are at the US is now at 5.5%, whereas in Canada we're at 5%, right, for the interest rates. So that basically created an environment of US dollar strength. That's why you see the Canadian dollar depreciating. It's not just the Canadian dollar, like a range of currencies have done poorly over that period, just because the US dollar has been really, really strong, right? So now the question is, does that US dollar strength persist in 2024, right? We think not, right? Because we're in our forecast, we're expecting the Federal Reserve to actually start cutting interest rates in the second half of the year. And that would basically trigger like a period of US dollar weakness, right? So that period of US dollar strength will go away, which may give the Canadian dollar some support, right? So it's entirely possible, Darlene, that you actually see the Canadian dollar finding some support, even though the economy isn't doing that great.
I understand. So that's a great overview of some of the macroeconomic trends, and thank you for that, Christian. JP, I'm going to turn it back to you now, and let's turn our attention to the agriculture sector. And let's start out with the grains and oilseeds. So the past few years, have been extremely volatile. We've seen an increase in the commodity prices, but also increase in cost in the grain and oilseed sector. So what do you see happening? Why did that happen in the past couple of years, and what do you see for 2024?
Yeah, so you're right. Lots of volatility. I would say especially in 2022 and the first half of 2023. And that volatility in 2023, for the second half of 2023, it's actually kind of faded away and has been replaced by, and that's not so great to say this, but it's been replaced by a kind of a sustainable, not a sustainable, but a constant downward trend in crop prices. And so we're at the point where we have much lower prices than what we had recently. And so that volatility is kind of looming in the background because we may be, just one major supply shock away from seeing prices rebound and that creating a little bit of volatility in the marketplace. But nonetheless, I think we're in a much lower price environment right now. A number of different reasons for this. We got good production in some major producing regions of the world. We have a global economic slowdown overall that does have an impact on the demand for commodities being a little bit weaker, and so that weaker demand actually leads to lower prices. So if you think of 2024, I do think that one of the critical aspect to think of is input costs. And not a surprise, as I said, I think in the introduction, since November 2020, that's what producers, most farm operations have top of mind. So what we did is, thinking about 2024, is build an index or an affordability index, I'll get it right, of fertilizer prices relative to crop prices. So what you see up on the screen is average fertilizer prices relative to average crop prices. And we're looking at a standard corn soybean rotation for Eastern Canada and a standard canola wheat rotation for Western Canada. In both cases, and the lines trend very similarly, actually. And I think the good news there is that we see this line towards the end of the far right of the chart. We see this line actually starting to come down in 2024. So that means that fertilizer prices, on average, relative to crop prices, will be lower. So that actually is a positive sign towards some profitability. But you'll notice as well that this line stays above what is the 5-year average. So overall, I do think that what this suggests, and then you can go and look at different inputs and so forth, this suggests that those profit margins for grains and oilseeds are going to be tight. They're going to be tight, especially for some operations that that have fixed costs that are large because they made some recent investments and so forth. So those margins, assuming that yields are average in 2024, those margins should be quite tight, in some cases even negative, and that should be I think what it does for me, thinking about this, is that it elevates the need to focus on farm management in 2024.
And if we maybe dig into, I'd like us to dig in a little bit more about the commodity prices moving forward. And we know that prices of commodities are influenced by the global crop production trends, what's happening around the world. So what are you monitoring outside of the Canadian borders?
Yeah, lots of factors to consider for sure. I'm going to start off in the U.S. So if you look at the U.S., the ratio of soybean prices to corn prices, and that's what you see up on the chart. You see the evolutions of the last 5 years, and you see our forecasts for the end of 23 as well as 2024. And that, even though that line's coming down, the bottom line is that on average, we're going to get a much higher soybean price relative to corn price. Really, that ratio, what it matters, especially in February, when crop insurance reference prices are set in the U.S. And what this basically says is that there is a strong incentive to see higher, seeded acreage for soybeans in the U.S. And so that's what the market signals are. So that's one of the things that we're going to be looking at over time. We can also think of South America, for example, right? We have Brazil that has had a little bit of a late start when it comes to plantings, but I think they're caught up because, if you look at some of the projections for the size of their crop, it looks to be a decent, sizable crop. Now, nonetheless, I think those projections are being revised downward at the moment, but I do think that there is going to be quite a bit of supply coming from South America. On top of this, Argentina seemed to have kind of made it past the drought year of 23, and their currency being devalued actually gives them an edge as well when it comes to world markets and the ability to export. So there should be plenty of supply in world markets. And then finally, if you think of wheat, for example, this is quite interesting actually, because if you look at the global stock-to-use ratios for wheat, and then we're projecting to be at the lowest point since 2015-16 yet, we've seen wheat prices actually come down. And so it's almost as if the markets are ignoring a little bit of the uncertainty that exists in the world, right? If you think of Russia's war in Ukraine, if you think of the conflict in the Middle East and the possibility that it expands beyond what it is right now and has impact on energy, on cost of transportation, when it comes to commodities. So there are a number of different factors that I think the markets are kind of being a little bit calm about, and it wouldn't take much, for volatility to resume in the marketplace. But unless we have, I would say, a major supply shock in the market, I do think that we're going to have to live with lower prices in 24 relative to what they were in 23.
A little adjustment to be had. So a good news story, though, for Canadian producers has been announcements of the build-out of new crush facilities here, both in Canada and in the US, so North American. How much capacity has come online with those new facilities, and what is the impact on the grain and oilseed sector? Yeah,
so actually, yes, you're right. I mean, the demand for renewable diesel, biodiesel is actually expanded. That led to a lift or a boost to the demand for vegetable oil. And so if you go back a couple of years, when we were looking at planned crush capacity for canola, we were thinking that maybe a couple of years ago that we would have in 2024 about 4.5 million tons of additional capacity. Now, fast forward to where we are now, what is different between now and then is that we had rising construction costs, we have high interest rates, we have limited availability of canola supply because 2 of the last 3 years weren't great on the prairies when it comes to yield. So all of that, I think, has led to some delays in terms of building that capacity that we were expecting for this year. Now, if you look at current plant run rates right now, they're 100% or above 100% of the 5-year average. So that suggests that we're already have a little bit of additional capacity. On top of that, we can expect, maybe between 1 million metric tons and 2 million tons of additional capacity in 2024. So there will be additional capacity, I do think, in the marketplace. Now, if you go south of the border and you look at some of the projections from the USDA when it comes to soy crush capacity or soy crush, they're projecting expecting about 3.5% increase for this marketing year, and another 2.5 or about 2.5% increase for next marketing year. So altogether, I do think that speaks to markets wanting a little bit more oil seeds and sending the price signals, certainly for soybeans relative to corn. I don't think we've seen it yet for canola, so that's going to be interesting as well to see how our markets evolve in 24.
Okay, thank you for that. So earlier you mentioned, you touched on droughts in Canada and around the world, and weather, of course, is something that we love to monitor in agriculture, and we need to monitor. So what are some of your expectations for 2024 crop season in regards to some of the trends that we've been seeing in the past in the weather trends?
Yeah, so far from being an expert on weather, but here's what we know, right? So we got the map of drought conditions in Canada, and if you look at the map right now, we got about 81% of all agricultural land in Canada under some sort of form or level of drought. Now, there are different levels of dry conditions in that map, but the bottom line is that we have a fairly large portion of the land that is under some stress. Now, it's about 100% for the prairies. So in eastern Canada, I think the things are looking a little bit brighter. In Western Canada, we got, like I said, close to 100% of agricultural land under some form of drought. But nonetheless, there's been some improvement, right? So if you go look at the map right now to what it was 12 months ago, you're going to see some improvements in terms of moisture levels, right? If you look at northern Alberta, if you look at just western Saskatchewan, I would say, I think are actually doing better now than what it was 12 months ago. But on the flip side of that, some areas are actually doing a little worse, right? Southern Alberta, southern Manitoba. So definitely something to monitor. I do think that customers over and over again are telling us that when you think of climate risk, adaptation and risk management are critical factors for not only the business success, but also business survival in some sense, right? So I'm only expecting that entire management of the risks when it comes to weather are just going to be so critical in this year and for the next few years, for sure.
Moving forward, we'll absolutely have to look at the impacts of climate change on weather and how it's impacting our production. And we've seen it in other crops too, right? In 2023, we can just think of the maple production. Harvest season production declined by 40% in the maple industry, and both in Ontario, Quebec, and New Brunswick. And we also see that in apples. We've seen it in apples and cranberries, in the wine grapes. So lots of impacts from weather, and something that we'll obviously be following very closely moving forward. So thank you, JP, for covering the grains and oilseeds. And I'd like us to now turn to talk about the livestock sector. And we're going to start with cattle. So in 2023, forecasts called for strong prices for the cattle industry, both for the fed and the feeders. However, with high feed costs and the impacts of the drought on the prairies, cow, calf, and feedlot margins were pressured. So to get a sense if the outlook for 2024 is any different, let me now introduce Des Sobel, Deputy Chief Economist at FCC. Hi, Des.
Hi, Darlene.
So, Des, what do you foresee for the cattle sector in 2024?
Well, I'd just like to call out, though, in 2023, yes, we actually did call out, forecast those record prices that we did see. So that was good news for the sector. So we had really strong prices. But when you look at it regionally, we did see that in Eastern Canada, there were good margins. They had adequate moisture. Then in some areas, they actually had a little bit too much rain, precipitation. But overall, the profit margins were good in Eastern Canada. When you flip to the west, though, this is where we ran into the drought issues. And so, the areas that were impacted by drought, they had feed availability concerns, feed cost concerns. And so we actually did see some of those margins were pressured. Feedlots were actually forced to import corn from the US. And so that added additional cost. And so as we see right now, even in southern Alberta, hay prices are roughly double what they were in the fall of, or in 2020. So, it's been a concern for the sector. The drought had a huge impact on profitability. The one good thing that's happened so far this year, or kind of late last year and this year, was actually the lack of snow. And so we have seen that the lack of snow has allowed some cow producers put their cattle on stubble. So they are actually able to save some feed costs there. So that's actually been beneficial for the sector as well. So if you look at this next slide on the screen here, what we're seeing for 2024 is that prices did start to decline at the end of 2023 from the record highs, and we're seeing those stabilize right now. So our forecast for 2024 is actually really strong cattle prices. This will support margins, and we're seeing this will continue on through the year and actually might increase in the latter half of the year. The one thing to keep in mind, though, is if you look at the chart, you can actually see that our cattle herd has been declining. And so this started in early 2000s. So with the outbreak of BSE, we saw there was a contraction in the cattle herd, and that's been declining. So actually where we're at right now is we're at a 3-decade low in the beef herd, and our replacement heifers are near all-time low. And so that's really putting some strain on the inventory levels. And you can see from that our cattle herd, because of BSE, has shrunk by 30% since the early 2000s. So overall, given strong cattle prices, feed costs that are starting to moderate, we're actually seeing profitability in 2024 that's going to be fairly good, not as high as 2023, but still above our historical average.
So let's go back to the inventory question. I've been thinking about that, and I'm wondering if in the beef sector, given the long-term contraction that's been happening in the herd in cattle, what do you expect for producers? Is there a possibility to grow that herd size back?
That's a great question. So herd expansion is something that's top of mind. So on the figure you'll see here, this is both Canada and the US. So this shows the number of cows and heifers that are sent to slaughter. And so we're actually at a decade high. So about 51% of cows and heifers are being sent to slaughter, which means those aren't being retained to build the inventory. So even with those strong price signals that we're seeing in the market, we're still seeing a lot of cattle being sent to slaughter. And so the rebuilding of the herd is going to take time. And so one of the challenges is that, especially in Western Canada, we've had a drought 2 of the last 3 summers. So this has really caused sentiment in the industry to be low. And so we've actually seen producer sentiment in 2021 has reached a low. It's only started to rebuild. And so that sentiment is something that needs to turn around for producers. We need to have timely rain. We need to have good precipitation this summer. And as JP alluded to earlier, when you look at Canada, across Canada, 81% of there's a moisture deficit. In the prairies, it's 81%. And so, 100% in the prairies. So, that's a challenge. And so that's going to weigh on producers. So that herd is going to rebuilding is going to take time. The sentiment needs to increase. And if you look back into 2015 and 16, when there was actually some strong price signals to rebuild the herd, they ended up staying flat. So the rebuilding is going to take time. It's not something that's going to be solved relatively quickly.
So Des, if we look at the cattle market, we really know that it's a North American market, right? So what's happening right now south of the border, and what's on the radar that Canadian producers should be really looking for, what's happening down south?
So when we look at the US, we've actually seen the Southern Plains region, which includes the Texas heartland, has had numerous years of drought. And so that's been ongoing there. So their cattle herd has been contracting as well. In 2023, it actually did improve. The drought conditions did improve. But even despite that, we saw a 3% decline in their cattle inventory as of July of last summer. So, and the overall cattle herd in the US now sits at the lowest level since 2014, with the cow herd being the lowest on record. So what it's really saying is ultimately, herds in both countries are going to be struggle to rebuild. So in the short term, there's still strong prices, so producers have incentive to sell cattle to get them slaughtered. And the cost of retaining heifers is actually quite expensive. So, going forward, it's going to be a multi-year process. We're seeing strong prices through 2024 and even into 2025. As producers start to rebuild herd, it's actually going to limit supply that'll go to slaughter as well.
That's interesting. And Christian mentioned earlier that inflation and food prices are really top of concern for the Canadian consumer. And how does that impact at the grocery store for the beef sector moving forward?
Yeah, so food inflation is widespread and beef is no concern. As Christian mentioned, household budgets are being constrained, consumer spending is being reduced. And so this is changing behaviors of consumers as they tighten their belt. So what we've seen in the last year is actually beef consumption has gone down. So as the affordability of pork has improved relative to beef, we've actually seen consumers shift their consumption away from beef and consuming more pork. So this is something that's not surprising given the high prices that have been faced. But from some of our research that we've done, we actually know that the demand for beef is really strong. So consumers, they like beef. They have a preference for it. And so once inflation starts to come down a little bit more, once food inflation starts subsiding, we will likely see that transition back to consumers eating more beef. I think the challenge, and I alluded to it earlier, is that there's going to be strong prices for all of 2024 and into 2025. So it likely will be retail prices will still be higher than average for beef, and so that might take some time for that consumption pattern to start to change.
Okay, Des, I'd love for us to now move into another red meat, and I'd like that we talk about the hog sector. So hog sector, we all know, faced huge challenges in 2023, and it's impacted profitability across the whole pork supply chain. Yeah. So what do you see for 2024 in this sector? Yeah, so 2023 was really definitely a year of adjustments for the hog sector. So like you said, it wasn't just the producers, it was actually processors had a really tough year as well. And so that was regional as well. So we know Quebec, there was price discounts for producers. Processors had excess supply, and so they weren't, they were constraining their slaughter at some of the plants due to weak profitability. And hog producers across Canada have had a few tough years. So the pressure on the margins over the last number of years has been quite hard on those hog producers. So what we're seeing now is actually slaughter numbers. So if we look at the slaughter numbers in last year, they were only up marginally at 0.7%. In Eastern Canada, where there was more of those challenges, the profitability concerns and the processing issues, slaughter was down 1.6%. In Western Canada, slaughter we saw was up about 3.7%. So like I said, the largest impact was in Eastern Canada, specifically Quebec. And so this did have an impact on breeding stock numbers as well. So this last July in the West was unchanged. And in the East, we actually saw a sow contraction. So it was actually the second year in a row that we saw that. So it'll be interesting to see the inventory numbers that are coming out on as of January 1st. It'll give a better indication of how processors and how producers actually adjusted to those tough and tight margins this last year and what holds for 2024 with them. The slide that's coming up on the screen shows that, the hog sector did go through a rapid increase in inventory starting in about 2015. And if you look at this figure, you can actually see the hog price to feed ratio, which is an indication of profitability, with a higher number being a better indicator of strength in the market. We saw the hog inventory being built up during that time. It started in 2015. What it really created was an excess supply of hogs. And so, as there was excess supply and demand wasn't keeping up with where we were at, that hog price to feed ratio started coming down. So that was the start of the profitability pressures. We did see it start to trend lower, and even despite that, it hasn't been up until the last couple of years that we've actually seen the contraction in the sow herd, which is something that's needed to bring that demand and supply back into balance. So what we're going to see for next year as our forecast is that, as supplies come down, that excess supply is being taken out of the market, demand is coming up a little bit, that our forecast is that prices are going to start to improve. But that's not going to happen actually until the middle of 2024. So the first 6 months of the year, there's going to still be tough margins, pressure on margins. Profitability won't improve until summer. So then, with feed costs coming down, we'll see through the end of the year that profit margins should be fairly positive. So a lot of factors to consider in the pork sector moving into 2024 to see where that goes. So thank you, Des. I'm now going to turn back to you, JP, and I'd like for us to dive into the dairy sector. So in many respects, the story in dairy for 2023, similar to other livestock productions, was really the feed availability and the cost to feed the herd. So that's really impacted the producers' profitability in the dairy sector. So what can we expect moving forward for 2024? Yeah,
no doubt margins were under some pressure last year in the dairy sector. I do think that margins are looking better in 2024. And there's a reason why. I can go back to 23 for a second here. There's a reason why, or a number of reasons why. We had a few challenges on profitability. If you look at interest rates, a lot of dairy operations had to make investment and had to renew loans at much higher interest rates than maybe 3 or 4 or 5 years ago. And so that created a few challenges. There's been quite a bit of disruption in the dairy sector at the beginning of the pandemic. And then we're just now starting to see the markets kind of just, finding its footing a little bit. So Number of different reasons. Bottom line, there's been some pressures. We think that if you look back at, if you look forward, that is, to 2024, we think that the margins are going to be a little bit better. Now, one of the key drivers of these margins are feed costs. And so you're going to see up on the screen what we call our index of feed costs, and that's basically what it shows is that there's a projected decline in that index, quite significant really, just right now at the beginning of the year, and the forecast is that despite a little bit of an increase sometime in the fall, that this index or this cost index for dairy producers is going to remain at a level that could actually mean, given what we know about the milk price, could actually mean that those margins in 24 could look a little bit like they were in 2019. So I think there's a lot of optimism now in this. The bottom line is that if you think of feed in dairy, a plus or minus 10% change in feed costs actually can lead to a plus or minus 40% change in net profitability. Now that's a big driver of profitability. So I think that for me the key message, Darlene, is that any operation that is able to gain a 2-3%, working with suppliers in terms of trying to gain a 2-3% efficiency in their costs, working through rations and so forth, would actually benefit a lot from working in an environment where margins are going to improve, but they're still going to be tight.
Okay, thank you for that. So, good overview of costs. Is there anything else that dairy producers should actually be keeping an eye on moving into 2024?
So there's plenty else, that's for sure, right? So let's talk about the milk price. So we know that effective May 1st, that there is going to be, on average, a 1.8%, a projected 1.8% increase in the milk price. So I think that's good news. That increase was initially supposed to happen in February, but because of some of the pressures that consumers face, I mean, the decisions was made to delay the increase, which makes good sense. And so now we're going to get a roughly 2% increase in the projected milk price. So I think that's good news as well for margins. Obviously, we have to pay attention to what's going on south of the border. About 12% of the butterfat is priced in function of what the price in the U.S. is. And so what the USDA basically says is that, yes, prices in the U.S. are going to come down from the highs of 2022, but they've been somewhat stable in the last 3-4 months. And if you look at the projection of the USDA, it actually suggests that those prices are going to remain somewhat stable. So again, we're not expecting any downside when it comes to U.S. prices, which should bring a little bit of support to the price paid to Canadian producers. Another factor or driver of profitability would be production, right? So we look at overall market requirements of the last 12 months. The most recent data points to a 3% increase compared to what it was 12 months ago. So demand for dairy products has been resilient. As a result, we know in the western provinces that we've had an announcement of a quota increase, so that's also good news from that standpoint. But if we have market requirements that are 3% higher than what they were 12 months ago, I think that suggests that dairy demand has been quite resilient despite some of the pressures that consumers have faced, right? So we've been talking a lot, going back to the discussion on beef, pork, dairy, of substitution that consumers make when it comes to their food choices. And there's no doubt that doing this, but it seems that to me that this demand has been quite resilient. And let's not forget that population growth in Canada for 2023, we've hit a rate that we've never seen over the last 40 years and more. That has actually been quite a bit provided a bit of support to the dairy sector.
Yeah, good news there. So lastly, let's talk about poultry. So avian influenza has had some negative impacts, of course, for the last couple of years, and again in this past year. That's still an issue, I understand. What else should we be watching for in the poultry sector in 2024?
Well, definitely right. It's still a threat. Avian influenza is still a threat in 2024. Major disruption in terms of the supply of hatching eggs, in 23, and so we've actually saw that production did not materialize up to what we thought the potential was. So that's one of the things to consider for sure in 2024. But there are other positives in that industry. For example, for producers, they've been revising the formula price just to acknowledge the fact that costs overall for producers have been going up. So that's, in terms of price that producers receive, that actually should provide a little bit of a boost to margins. We've been talking about feed costs coming down or being stable, so that also should actually provide a little bit of a boost. And I'm going to still end up talking about demand, right? Because population, when it comes to supply managed sectors, poultry, dairy, population growth is a big driver of profitability in terms of volume sold, volume produced, and volume sold. But right now we're paying attention to stocks, frozen stocks of poultry meat, for example, and they're quite high. So we just need to be thinking about, all right, how much consumers are able to absorb in terms of higher prices to reflect higher cost of production and not lead to a substitution away from poultry products, right? And I think that's one of the things that the industry is going to have to monitor in 2024, just to make sure that we don't find ourselves in a situation where supply kind of exceeds demand.
Yeah, we don't want a surplus of inventory.
Yep.
Right. Okay, thank you. Thanks, JP, for covering those sectors in primary agriculture. And I'd like to now turn our focus downstream in the food supply chain and discuss the outlooks from the perspective of food processors. So, Des, what are the most relevant trends that we should be monitoring moving forward for the food processing sector?
So, Darlene, food inflation. So I want to talk about that again. I know it's a hot topic. It's something we've discussed already. But it's important because what the consumer does actually will have an impact on food processors as well. So if we look at food inflation, and Christian showed this earlier, we've actually had 2 years now where food inflation has been higher than overall inflation. So one of the top questions consumers are asking are, when is food inflation going to fall in line with overall inflation, or actually will it? And so that's a question that's top of mind. So research that we've done, we look at how long it takes for processing prices to make their way through to retail prices. And so this chart on the screen coming up here will show where we're at with food inflation, as well as the food manufacturing prices. The key point from this chart is to actually look at how long it takes for that price to flow through the supply chain. And so we can see it's roughly 9 to 12 months. So early on in the pandemic, it actually, food manufacturing prices went up quickly, and food and grocery prices didn't go up for a few months. And now we're seeing the flip side. So as food inflation has come down, it's at 4.7%. We've seen that the food manufacturing prices are come down to 0.4%, which is a 5-year low. And so we're seeing this, and it's come down from about 10%. So with this deceleration in food manufacturing prices, that's going to flow through to retail prices, but it won't likely happen until probably mid-2024 or even later into the year. So it's something that we have to be mindful of, and that will actually benefit consumers, but it will weigh on food processors as that demand has changed.
So you said food inflation, we know, is now moderating, and it's expected to continue to slow down in 2024. And that's great news for the consumer, but you also mentioned earlier that what the consumer does has a direct impact, right, on his or her consumption habits has a direct impact on the food processor. So what does that mean for the food processor?
Yeah, so what we've seen over the last number of years is actually really strong manufacturing sales. And so in the chart here, you can see through the pandemic, sales growth is really strong. In 2023, our forecast is sales about 6.3%, which is still strong growth, and then actually slowing to about 2.4% next year. Or sorry, 2.5. But the one big thing to factor into this is this includes inflation, or the impacts of inflation. So if you actually take inflation out of these sales figures, and it gives you more of an indication of what volume is at, we've actually seen in 2023, that would come in at less than 1%. It's about 0.7% would be the sales growth. And so for 2024, if you do the same thing, sales growth would actually come in at less than 2% when you exclude inflation. So it's not surprising. What we've seen is the volume hasn't been very robust because of what consumers are doing. So consumers actually are spending less. If you adjust for inflation, are actually spending less at the grocery store now than they were, during the pandemic. And so they're spending about $3,300 per person was what the spending was in the year prior to the pandemic. That is now about $3,100. So we're seeing that those households are making some tough decisions. They're choosing where they spend their money. They're buying, say, some of those lower value added goods. They're maybe minimizing food waste. And even some households are actually consuming less food. And so this is going to be weighing on some of the sales and the volume for these food processors going forward.
And I suspect that those sales, it's variable depending in which subsector of the food processing sector that you're actually operating in. And I think we'll have to wait for FCC's food and beverage report that's coming out here at the end of March to get all those details, right?
Yeah, that's a good plug for the report. It's a fantastic report. I'm going more of a high-level overview of the sector, but that report will actually go into each sector, subsector, and do a very detailed dive into sales and margins. So what we've actually seen, though, in 2023 was those sales, were still decent at 6.3%, but because costs were still quite high, we actually saw a contraction in food processing margins. And so the figure that's coming up here, you'll actually see that our index of margins in 2023 actually hit a low of 88.5. So we've seen that declining trend over the last number of years coming out of the pandemic. The good news is, even though sales are slowing heading into 2024, we know that costs have come down as well. So we're actually going to see an improvement in margins. It's improving over highest it's been in the last 3 years. So that's a good news story for the sector. I did want to focus on wages because I know that's one of the key topics, and Christian touched on labor earlier. And so what we've actually seen is those wages are actually cooling. As the economy softens, we're seeing those vacancy rates come down. And so we're seeing that labor market is going to be loosening up a little bit. And so that should bring down wages. And so that'll actually help the sector as well with reduced wage costs. So it's getting somewhat optimistic. It's making that turn, I think, out of the pandemic and post-pandemic. So we're going to see some positivity in the food sector going forward.
Great. Thanks for that overview, Des. Really appreciate it. Now I'd like for us to move on to the agribusiness sector and talk a little bit about that sector. And I've heard from recent conversations that equipment manufacturers and dealers have noticed, or there's been a true decrease. I'm looking for the proper word here, that has been characterized in farm equipment sales and inventory over the past few years. And that stemmed from supply chain issues, Kirsten. So as a result of that, we've seen rising equipment prices over the past few years. So what are we expected to see in 2024? Yeah, so
you're absolutely right. I'll say soaring prices, Darlene, because because of the supply chain issues, we've seen a demand-supply imbalance, and prices have actually risen on average farm equipment 16%, right? So that's 4 times the rate of inflation in Canada, right? So significant increase. Now, with the supply chain issues almost like in the past now, dealerships are replenishing inventories, right? But that's not to say sales will rebound, in a substantial way, because, like I said, prices are really, really high. And also, interest rates are elevated. And even though, like I said at the beginning, the Bank of Canada is going to probably going to cut interest rates in the second half of the year, but rates are going to stay high for a while, right? So you have a situation with high prices, high interest rates, and like JP mentioned, profitability challenges in agricultural production. So those things lead us to believe that demand for farm equipment is not going to be that great either, right? So we're still forecasting, as you can tell on the chart that's coming up, sales. We're forecasting sales to decline across all tractor classes this year. But that's not to say that we're not going to see a rebound in sales later on in the year and in 2025, right? Because, like I said, the Bank of Canada is probably going to cut rates later in the year, and that could precipitate an improvement in the economy towards the tail end of 2024, and profitability could also improve, right? So there's a likelihood that sales is going to rebound towards the later 2024 and into 2025, Darlene.
Okay, great. Thank you for that, Christian. Okay, so we're getting near the end of the event, and I'd like to now turn it back to you, JP. What's your overall assessment for the outlook? In a few words, what do you see for 2024 for the agriculture and food sector moving forward?
Okay, a few words. I would say cautiously optimistic. I'm optimistic because we're going to get relief when it comes to interest rates. We know that costs for some sectors are going to be coming down, so that's going to help profitability. But cautious as well because consumers are under a little bit of pressure, and it all starts with consumers, right? So we need, and then we're thinking of Canadian consumers, but let's not forget that this inflation story and higher interest rates, that's really just obviously a global story as well. You can look to China with some of the issues that they face on their own in terms of the impact that they have on commodity prices and so forth. So that's the reason why I'm saying cautious. I think we're going to get some relief throughout the year. I think we're going to see things improve. We might have a little bit of a more difficult start to 2024, but I do think that on the overall, I think we're likely to end the year on a more positive tone. I think that in this environment, I do think that management skills are absolutely critical, right? As I alluded to at some point, any 2, 3, 4, 5% that you can get in terms of efficiency, in terms of productivity, will help on the bottom line because there's a multiplicative effect when it comes to lowering your costs and the impact on the overall profitability of the operation. So I would say, cautiously optimistic that we'll get through this year. I think the long-term outlook for the industry remains extremely positive. I think there's a very, very strong demand for what we can grow and produce as food. And so that's the reason why I think we're still very optimistic about the long term.
Great. Thank you for that. So that's it for the 2024 FCC Economic Outlook. A recording of this event will be available soon to all of those that have registered. So if you've missed any piece of information or you would like to go back and watch it again, please do so. I encourage you to. And I also encourage you to keep checking back on the FCC website. You can go to the Knowledge tab and then click on Economics. And within, you will find top economic charts to monitor, forecasts for farm income, sector outlooks, a whole bunch of resources within that tab. So with that, on behalf of all of the FCC staff, we wish you have a very successful year ahead. See you soon.